Hey guys, and welcome to the final episode of the financial statement analysis series, the series where I go through all three major financial statements. That is the income statement, the balance sheet, and the cash flow statement. We went through the income statement in episode 1. Go check it out if you haven't already, and go check out episode 2 of the balance sheet if you haven't seen that. But in today's episode, we're going to look at the cash flow statement, which is my favorite one to look at because it tells us all about the cash flows within the business. And not only are we going to look through the main components of the cash flow statement and what we're looking for in the cash flow statement as investors in businesses, we're also going to bring it all together, bring the series together. And I'm going to show you how each of these statements work together to tell us a story about the businesses that we're going to be investing in. If you are enjoying the series, make sure you let me know by leaving a like on the video and also letting me know your thoughts down in the comment section below. But for now, guys, let's jump into it. All right, guys, so we're up to the final episode of this series where we're going to have a look at the cash flow statement. That's not the cash flow statement. This is the cash flow statement. So this is an exciting one. I've got lots to talk about in this one because this is the statement that I look at the most. I find myself looking at this the most because it's all about cash. And cash is king when it comes to investing because the more cash that you can make, the better an investment is, ultimately, because that's what we're trying to do. We're trying to put out some cash, we're buying some businesses with our cash, and we want to bring back more cash. So it's important to understand how much cash is being generated within a business. So the cash flow statement is exactly what it sounds like. It tells us how much cash was spent during a particular period. Now, if you remember back to the first video in this series, we spoke about how revenue and expenses on the income statement are only included if the benefits were provided during that period. On the cash flow statement, this is completely different. The cash flow statement tells us how much cash was spent or produced during the period. So if a company paid all of their staff up front for the year, that big cash payment would be included in the first quarter cash flow statement, but would be spread throughout the year on the income statement. So that's the difference between the two. The cash flow statement also doesn't include any non-cash expenses. So things like depreciation, they're not real expenses. They're only recorded on paper, so those items don't appear on the cash flow statement because no cash changes hand when there is a depreciation expense. Ultimately, this statement just tells us how much cash was produced by the business for the owners. And the statement is broken down into 3 sections to explain what the cash was used for throughout the period. So we've got operating cash up the top here, operating activities, we've got investing activities, and we've got financing activities. Those are the 3 sections, and let's go through each of them and explain what we're looking for in each. So we'll start with operating activities or operating cash flow. This is basically the cash flow in the business for the normal operations of the business. So this includes the purchase or sale of inventory, operating costs such as wages or advertising and sales and that sort of thing. And it also includes other things such as changes in how much is in the accounts payable or accounts receivable. So how much money is owed to us in the short term and how much money we owe in the short term. Any changes in that represents a change in the amount of cash in the normal operations of a business. The second section we've got here is investing activities or investing cash flows. And this section is talking about cash that is used or produced by long-term investments. So the first item on this is usually capital expenditure. It's not for here, it's written here. It's also known as payments for property, plant, and equipment. So you can see that it's a couple of levels down. So this is capital expenditure, this number right here. And basically CapEx is where you're buying and maintaining buildings, machinery, and other long-term assets to maintain and to grow the business. So it's what's being used, what is the capital that's being deployed to make investments to maintain the assets, so to restore assets to how they were, make machinery, repair machinery and repair the buildings and that sort of thing, as well as buy new buildings and buy new machinery and better machinery and sort of grow the business. So investing activities, just think it's all about long-term assets. So in here we've also got acquisitions, and we've also got the sale and the purchase of marketable securities. So any long-term assets that are being purchased or sold, that'll appear in the investing activities. And the last section, of course, we've got is financing activities. Now, this relates to long-term debt and equity. So we'll go back to the top and I'll just explain. So we've got Operating activities is talking about short-term assets and short-term liabilities. So things like inventory and accounts payable and short-term debt and all that stuff. Then we've got long-term assets, which is what is being dealt with in the investing section. And then in the financing activities, we've got long-term debt and equity. So that's what we're talking about here. And basically this shows all the cash flows relating to paying down or taking on more debt, issuing shares or buying back shares, as well as paying dividends. So you can see here that we've got proceeds from issuance of stock. So that means that they sold more stock on the market, and that's how much money they got from it, 600 million. The next level here, what have we got here? Payments for taxes relating to net share. Don't worry about that. Don't worry about that. Payments for dividends. So they paid 13.7 billion in dividends to the owners. Repurchase of common stock, that was 72 billion. And also here we've got repayments of debt. So they've repaid 6.5 billion in debt during this period. And as you can see, we've got from operating activities, they were positive 77 billion. In terms of their investing activities, they were positive 16 billion. And then in terms of their financing activities, they were negative 87 billion. So they spent a lot of money in relation to long-term debt and long-term equity. And that's actually a positive thing. And we'll get into what this means, but that's actually a positive thing because it means that they're paying dividends, it means they're buying back shares, and it means that they're paying down debt. So let's talk about how we analyze these in terms of our investments. So there's a couple of things that we look for when analyzing the cash flow statement. And the first thing is that the company must be operating cash flow positive. So this number here, cash generated by operations, this needs to be positive because that means that they're bringing in more money than they are spending in the normal operations of the business. If a company isn't operating cash flow positive, then there is something seriously wrong with the business. And they will have to keep on taking on more debt just to keep themselves alive. So basically how you should look at this cash flow statement is we've got cash generated by operating activities. This is how much money that they generate and that they can use to invest. So the next level down is investing activities. Now, this doesn't have to be positive because if it's negative, it just means that they are investing. And we can't tell if those investments are going to be good or bad, but just because they're investing, that's not a bad sign. But we definitely want operating cash flow to be positive because we want them to use the positive money, the positive cash generated by the business to invest and also to pay down debts. Now, if this is negative consistently, then they are going to be taking on debt down here in the financing activities in order to pay for that. Because if they're not making money with their normal business, then they have to use debt in order to maintain their cash positions. The second thing that they need to be is they need to be free cash flow positive. So what free cash flow is you take this operating activities number and you subtract payments for property, plant, and equipment. Now, this is also known as capital expenditure. So we're taking operating cash flow minus capital expenditure. Now, you can see that they had capital expenditure of about 13.3 billion, and they had operating cash flow of about 77 billion. So Apple's free cash flow for this period would be approximately about 64 billion. So that's very positive, which is great. And we want this to be positive over time, consistently positive. And what free cash flow tells us is how much cash a business produces after investing in maintaining and growing the business. So it's essentially excess cash that could be paid to the owners as a dividend. It could be used to pay down debt. It could be used to buy back shares, or it could be used to and sort of kept as cash for future investment. So we're looking for free cash flow to be growing at 10% or more over 10 years, and of course, again, improving over time each and every year. And the reason for that is that free cash flow is a really strong indicator of how a company's price will grow over time. If you could imagine that a business just kept all the free cash flow in cash, then every time they produce free cash flow, they are increasing the value of the business by that amount. So if you could imagine that instead of paying down their debt or doing anything that they did, no dividends, any of that, they just took that what was it, 64 billion in free cash flow, and they just stuck it as cash on their balance sheet, at the very least, the company is now $64 billion. It's worth more 64. It's worth by more than 64 billion because it's just cash. So if you own the business, you now get an additional 64 billion in cash. So that is the minimum that it should increase the value of the company. Now, as I said, investing cash flow can be negative because it just indicates that they're investing, and that's not necessarily a bad thing, but it's also not necessarily a good thing. And lastly, we have financing cash flow, and this is an important one to watch. Often companies that aren't free cash flow positive will be taking on large amounts of debt in order to stay alive. So ideally, you want a company that has plenty of free cash flow and isn't taking on large amounts of debt. Now, if you notice that a company is taking on large amounts of debt while at the same time paying down a lot of debt, then it can indicate that a company is in a dangerous position. Irresponsible management will sometimes pay off a lot of long-term debt with more debt. And this can be easily managed when interest rates aren't changing and when they're low and when credit is easily available. But if we get into an economic downturn, often interest rates will go higher and credit is less available, which means that if a company can't find more debt to cover their initial investment, they'll go bankrupt. So that's a very dangerous position to be in. So I just want to show you Netflix's cash flow statement because this is an example of a bad one. So we'll go cash flow, go down, see how long this is going to take me to find this. Here we go. So cash flow. So you can see that from operations, they're negative. Then they're not even breaking even. And this is because they're buying a lot of sort of streaming content assets at the moment. So they're negative there. And as a result, they're having to take on debt. So you can see they issued 3 billion in debt. They issued 1 billion in debt. They issued 1.5 billion in debt. So they're having to issue lots of debt because they're not operating cash flow positive. So that's just an example of a company that I would stay away from because they're not even generating positive cash from the normal operations of their business. So in summary, free cash flow is one of the key areas that I focus on when investing because if free cash flow is slowing down, then you can expect that equity growth will slow down in the future too. And equity growth over the long term will be closely aligned with the growth of the stock price, as I said in the last episode. So I just thought I'd summarize the series in this episode and just wrap it all up, and we can sort of see how these three statements explain a story and sort of tell us a story about the company. So if we start off, we've got revenue and earnings on the income statement. Revenue and earnings per share. And this tells us how much money is being produced and how much remains over a particular period. For Apple, that is 266 billion that they're bringing in, and they're keeping about $11 per share, or about $12 per share. Then if we look at the cash flow statement, we can see that they're generating about 64 billion in free cash flow. So that's how much actual cash is being produced by this company. And then if we look at the balance sheet, it tells us how much equity is being generated over time and how much equity is growing over time. And that's ultimately telling us how much our business will grow over time. So how much cash that a business distributes to its owners in the form of dividends or buybacks, and how much cash is used to grow equity is ultimately how much money you will make from an investment. So we have the financial position represented on the income statement in how much money brought in and how much is kept. We can have a look at the cash flow statement to see how much cash the business is generating for its owners. And then we can look at the dividend and the growth of equity to see how much money we can expect to make from this stock. So I hope you guys enjoyed this series and I hope it was helpful. Let me know your thoughts down in the comment section below. And of course, leave a like if you did enjoy this series. And if you want to see more sort of similar videos like this, sort of me just explaining different aspects of investing, going a little bit deeper for those who are really serious about investing, then make sure you let me know down in the comment section below. But for now, guys, I hope you have a great day and I'll see you in the next one.